70% of the times there is no trend in the market. Only 30% of the times there is a trend in the market. And this is actually when you can make money, when the market is trending. So as a trader, you need to know when the market is trending and when not trending. But you may ask how? The most effective way is price action analysis, but there are also indicators that can help you on this. We have trend indicators that can help you with identifying trends, and we have range indicators that can help you with identifying non-trending market. The most basic form of a trend indicator is moving average, and many of the other indicators are built based on moving averages. In this video, I want to introduce a comprehensive moving average that can effectively help you with identifying trends. I will teach you a simple trading strategy based on this indicator, so make sure you watch this video until the end and let's get started. Before we start, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, on TradingView platform, here we click on indicators and we search RK10, this one. RK10 MA types ribbons, which is written by Rodrigo Kazuma. Alright, this is the indicator, and as you can see, a ribbon is added to the chart. But this is not just an ordinary moving average ribbon, and it has many features and options that gives you flexibility and complete control to adjust the indicator exactly based on your need. If we go to the settings of the indicator, here for moving average setup, you can see that we have a large list of different types of moving averages that you can choose from this list. Depending on your trading strategy and other indicators that are used in your trading strategy, you may need, for example, Arnold-Ligox moving average, or you may need triple exponential moving average, or just a simple moving average. So here we have a complete control on the type of the moving average that you are interested to use. And then for the collection of the moving averages that you need, here you have a complete control how they should be plotted on the price chart. If you need 2 moving averages, 5 moving averages, or 10 moving averages, you can set it here, and here starting length for the moving averages and what step they should increase in the value of the length. And here you can choose the method, for example, Fibonacci sequence or arithmetic difference or even manual. I found Fibonacci very useful, so I continue with Fibonacci method. The starting length is set at 8 by default, so starting from 8, we will have 10 different moving averages that are incrementing based on Fibonacci sequence. Here, let me scroll down and I remove inputs in the status line, so it will not cover the information on the price chart. So here we have 10 moving averages starting from 8 based on Fibonacci numbers. And here on the right side of the chart, in this table, it is also showing that we have 10 moving averages on the price chart with length of 8, 13, 21, 34, and the longest one is 610. So here we have a collection of 10 moving averages from a very short length, which is set at 8, and very long length, which is set at 610. Alright, before I start explaining how you can use this indicator for identifying trends and evaluating the strength or weakness of the trends, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a comprehensive guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. Alright, as you can see, we have a ribbon on the price chart, and depending on the direction of the market, the color is either green or purple. As I mentioned earlier, we have a collection of moving averages from short term to long term. When the price closes and goes above the longest moving average, which happened here as you can see, it is a signal that the market is turning to an uptrend, and the indicator also shows a signal like this. When all of the moving averages from short term to long term are pointing to the same direction, it shows that the price is advancing strongly. But when the price starts to crossing the moving averages, that shows weakness in the trend, which could be just temporary in the form of a pullback or flat market, or it can be more serious and early stages of reversal. So when all of the moving averages are pointing to the same direction, which is when the price is above all the moving averages, it shows that we have a strong upside momentum in the market. And in this situation, we only see green color in different shades, as you can see. But when some of the moving averages show opposite direction, which is when the price starts crossing the moving averages, it shows weakness in the uptrend. And we see that the other color of the ribbon is appearing when the price is closing below the moving averages one by one. As long as the price is above the longest moving average, we can say that we are still in an uptrend, and we can say that these are just weaknesses within the uptrend. They are usually pullbacks, and we can take advantage of them and enter a trade in the same direction with a longer term trend of the market. Later, I will teach you a simple trading strategy based on this, so make sure you watch this video until the end. Alright, on the other hand, when the price is in an uptrend and after that the price starts closing below the moving averages, and this happens all the way down below the longest moving average, which happened here at this point, as you can see, it is a signal that probably the price is turning to a downtrend. And the indicator also shows a signal like this. When all of the moving averages from short term to long term are pointing to the same direction, which is actually when the price is below all of them, it shows a strong downside movement of the price. And when moving averages start showing different direction, which is when the price crosses and goes above them, it shows weakness in the downtrend. And we also see that the green ribbon appears. But as long as the price is below the longest moving average, we are still in a downtrend. And these weaknesses could be just temporary weakness because of a pullback, and we can use them to enter a trade within the downtrend. Here, I should mention an important point regarding these signals, because not all of them are correct signals. Better not to focus on these signals as trade entry, because in times that the price is in a trading range, like here in this part of the chart, you can have many false signals. You should focus on this indicator for trend identification. From the point that the indicator completely turned to purple, the market is trending down, and we should look for short position opportunities. And from the point that the indicator completely turned to green, the market is trending up, and we should look for long position opportunities. Let me show you an example so you better understand. Here we click on indicators and we search Andean oscillator, this one, which is an editor specs indicator and written by Alex Grover. Alright, this is the indicator, and it's one of the best indicator for identifying buy-sell signals because it can help you with both of trending and non-trending markets. As you can see, we have 3 lines here, which are red, orange and green. In times that the orange line is above the other two, it shows flat market, and when the red line is above the other two, it shows that the price is declining, and in times that the green line is above the other two, it shows that the price is advancing. Alright, let me show how you can find trading opportunities by the help of these 2 indicators. When this moving average ribbon is showing downtrend, here in Andean oscillator, we want a situation like this where the red line crosses above the green line and then it crosses above the orange line. We don't take crossings like this where the red line goes below the orange line and then it crosses above the orange line. This is not accepted. We want exactly a situation like this where the red line crosses above the green line and after that it crosses above the orange line. So here we have a confirmed sell signal, and in practice we could enter a short position at this point when the new candle was opened. The stop loss for this trade is placed above the previous swing high, above the pullback, and profit target at 1.5 risk to reward ratio. To show you another example, here you can see that we have the situation that we need. The ribbon is showing downtrend, and here the red line crossed above the green line, and after that it crossed above the orange line. So we have another confirmed sell signal here, and in practice we could enter a short position at this point with the stop loss above the previous swing high, above the pullback, and profit target at 1.5 risk to reward ratio. On the other hand, when the ribbon shows an uptrend here in Andean oscillator, we want a situation like this where the green line crosses above the red line and then it crosses above the orange line. This is exactly the form of crossings that we need. First, the green line crosses above the red line and after that it crosses above the orange line. So here the buy signal is confirmed and in practice we could enter a long position at this point when the new candle was opened. The stop loss for this trade is placed below the previous sewing low, below the pullback, and profit target at 1.5 risk to reward ratio. To show you one more example, here you can see that we don't have any confirmed setup up to this point where the green line crossed above the red line and after that it crossed above the orange line. So we have another confirmed buy signal here at this point. So in practice we could enter a long position here when the new candle was opened. The stop loss below the previous sewing low, below the pullback, and profit target at 1.5 risk to reward ratio. Please pay attention that this is a trend following strategy and in times that a reversal is happening, you may encounter a false signal at the last movement of the price before the reversal, or during range market you may encounter false signals. This is completely normal with trend following strategy and you need to manage your risk properly. You can still avoid many of the false signals during range market. The most effective way is price action analysis, but there are also some indicators like ADX that helps you to know when the market is not trending, but you cannot completely remove all of your false signals. This is not possible in reality and you need to manage your risk properly. There is a risk management strategy that is called 1% rule and it's one of the best risk management strategies recommended by professional traders. I have a complete guide on this. The link is also placed in the description and I highly recommend you to watch it because without a proper risk management strategy you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.